Thank you.
Hopefully. 1, 2. Missing some. Oh, here he is. Come on. Come on. Don't be bashful. Can't the drinks be earlier than 5? We're ahead of time. So I realise we stand between you and some drinks. Hopefully the alcohol is in celebration of a good day rather than drowning your sorrows. Let me introduce the guys to my left. You need that, your slides. First of all, you've got Chris Wilson here, who runs Value at Energy in London. Historically a Canadian consultancy with excellent data reservoir, and they are driving that out into the wider world. Next to him is Andy Morrison. Andy is currently chairman of Spinnaker, which has been a shell company looking to acquire, but Andy's history has been in small oil and in recasting a number of small oil companies over the years. And on the end, not least, is Sachin Oza. Sachin has recently stepped into Rebold Resources with an acquisition bent and a restructuring bent. I would suggest that he brings a level of analysis to that parts of this industry have not seen for a considerable period, and that is based on my former experience of him on a buy-side role in M&G. What I suggest perhaps we start with is perhaps 1 or 2 minutes of each of the panelists just giving their overall flavour on the M&A and some lessons or current topical points that they have, and then we'll go into some of the issues you see on the prepared questions and then throw it open to the floor. Chris, you have some slides. Would you like to step up here so you can see them? Rather than give you a pain in the neck.
So we'll just have a quick look at the empirical, what's been happening in terms of the M&A side of things. So it has been a challenge, and there's some interesting insights that you can draw from the analysis that we pulled together. So we track every single oil and gas deal globally, renewables and other areas as well, but oil and gas is our specialty. So there's always this very strong correlation between the WTI price. You can see from the period Q1 2014 to 2015, there was that real no-go period where nothing was happening. But the markets actually came back quicker than a lot of people thought on that. And there's some reasons for that, and some of the drivers. We'll have a quick look into that. The US shale plays have really been resilient in helping push that deal count and value back up. More recently, we've taken out the Shell deal as well, which is something to mention at this point, because someone will remind me, 73 or 93 million US dollars. That was at that point in time seen as potentially heralding in some significant corporate deals, bringing G&A costs together, lowering costs on that basis. It really didn't take off, and that was quite against what a lot of analysts thought at that point in time. So there hasn't really been a lot of insight into why that happened, but it's been, since that point in time, there's been a lot more focus on asset level M&A, and that's what's really driven everything since that point in time. And the resilience of the shale play is actually what's taken some of that focus away from there, and all of that's driven by those low operating costs. More recently, there's been a real strength in looking at regionalization, specialization. Some of the drivers in here, you'll see North America is actually not just shale play. There's been some of the Canadianization, so the oil sands hasn't been seen so popular, but they've actually been reselling themselves in terms of looking at that geographic specialization. A lot of the people who are speaking here today, there's been that shift in our thinking within the industry that we're actually looking at what's the story we're telling, the change in story, and it's very much the success factor in getting out and talking to the market and getting those people to come and listen to us now is very much looking at what is our specialty. We know an area, we can get the best margins out of that, and that's all driven by the oil price. So we'll just having a quick look again at what the asset values that have driven that M&A activity. You can see that it hasn't been those corporate deals, which tend to be larger. It's actually the asset level deals that have really driven it. And there's been a change in that, in understanding, who are the buyers and sellers and what the relationship is there. And a lot of the, there's also the reasons of companies actually specializing in looking at their core portfolios. But the buyers in those situations, what are those companies? They're looking at actually really focusing on their core portfolios and focusing down on their core areas, and so that they can understand that, they can understand exactly where they can make the profit and where those margins are within there. So just an overview of what's been happening. It's very much in line with WTI price. The two big spikes, they're from the in Q1 Q4 2016 and Q1 2017. They're almost entirely pushed by the Canadian oil sands deals, which are quite significant. Other than that, there's quite a strong trend on the assets play there. We'll have a little bit more detailed look in a few minutes, but I'll pass on from here.
Thank you very much, Chris.
Thanks.
So we'll try and throw some of the data in as we go through, so that you can conceptualize some of the points here. Andy, would you like to say a few points about your experience, current and past, of how M&A is a useful tool at building successful companies?
Hello, good afternoon. So just a couple of words on Spinnaker Opportunities PLC, which most of you will not have heard of because we are a very new cash shell. We came to the market in May this year, really as a new take on the shell idea. We are a genuine alternative, if you like, to IPOs because we raise money. We don't take any salaries at all. We don't have any costs. People have talked about low G&A today. We have nil G&A, more or less. And so what we are acting therefore as an investor in the market. And we've been on the market since May this year. And we set ourselves out with the idea of looking across the sectors at energy and industrial businesses. So we didn't say that we must do oil and gas. In fact, we've looked at a broader range. And so the perspective that I bring to the group here, I hope, is that we have been over the last few months looking at a variety of different sectors and opportunities. And I think I found myself nodding with a lot of the presentations and commentary that I've heard today. I think a lot of the themes are kind of well understood. But for M&A and for a small shell like ourselves, it comes down to very old-fashioned, simple things about buying smart, for example. So we've heard people, and I'm going to draw on one or two examples I've heard today. We've heard people like Pan Continental, where you've heard a story about buying smart. And I think when you're involved in M&A, then getting in at the right price is obviously essential to success. And I think we've heard themes. I've been nodding as well, thinking when I've heard people talking about data and technology. The oil industry has been very slow over the years in taking up technologies, and so we've been quite interested in in some of the projects we've seen, which have been big data, bringing technology and data management to the oil industry in a faster way than perhaps they've been used to in the past. And I think finally the other thing, where we've looked at oil and gas, and we have looked at oil and gas, and we still look at oil and gas, and we've followed some of the themes that we've heard about today, and we're not looking at Trinidad, just to give you an example, but there are various players here from Trinidad, and I think that is a good example of the kind of plays that are supported by the market at the moment, where you have production and you have upside there, and where it's open for small companies to participate. So those are some of the areas where I've seen that on the small scale M&A there is room for value creation.
Thank you, Andy. Sachin.
Is this working? Yeah?
Yes.
Okay, perfect. Thank you, John. So answering the question, sort of seeking upside from mergers and acquisitions, I'll provide a little bit of background, maybe from my previous incarnation, as John had said, on the buy side, and I'll try and say this relatively quickly. If we go back sort of 2007, 2008, and just prior to that period, as the oil price was running up, we were in a situation where the industry at large, indeed potentially led by the majors, were allocating capital into the expectation of an ever-rising oil price where they were finding their ability to replace reserves increasingly more and more difficult. And I think through this period of time, as they were rolling out the capital expenditure, trying to keep a pace with this depleting trend of reserves, the difficulties of managing the quality of their portfolios started to come through. I mean, a simple fact that I think Exxon was earning a lower return on capital employed at $100 per barrel of oil than it was at $40 per barrel of oil is something that kind of is shocking, but worth remembering. Now, from that period of time, I think what we've seen is an intense drying up of capital as the rationing of capital by the industry led to the preservation of capital almost to stay alive at that stage. And this led to something that I think was quite significant and profound, which was so many assets of good quality and bad quality started to be shed, but then ended up with no capital to take them forward. And I think it breaks down now into two parts of being able to create upside from that backdrop, assuming you believe it. The first, and the area that Reobold is focused on, is that for pre-cash flow assets, where huge amounts of capital has been sunk, it is possible to pick these up at well below ground floor terms and with modest amounts of capital to take them forward to start generating a return. And by generating a return, these things are more than 50% type rates of return, and genuinely so. The difficulty is each individual opportunity might be quite small and goes under the radar. And by trying to aggregate them around a geological focus, or to shorthand it, a geographic focus, you can slowly start to build up quite quickly and very cheaply an incredibly impactful portfolio. And there is the scope at that end of the market to achieve fantastic returns, kind of irrespective of where the oil price is. Please bear in mind the statistic I just provided on Exxon. The second part of the portfolio, and this is outside where we're involved in, but you see the activity, which is in producing assets that have been starved of capital as the same approach of preserving cash flow as much as possible. And you've seen some of the private equity players start to try and build their portfolios that way, and Engie selling their portfolio was just one more recent example amongst a number of others. But inevitably, for producing fields, by far the dominant factor of returns is oil price. So in the post or producing cash flow phase, although yes, you can definitely make returns by improving CapEx, OpEx, and indeed getting a better production profile, I tend to find that through the cycles, the dominant return characteristics of that portfolio is oil price, and getting in at the right time when the oil price is low, and having invested then and then benefiting from the rise in the oil price, or in the phase, I suppose, where it sounds like Andy and I are focused, where you're much less sensitive to that and can get what I believe are more powerful risk-adjusted returns. And those are two ways through M&A, given the backdrop I just provided, that I believe you can generate returns.
Thank you, Sachin. What I'd just like to do is to remind everybody of the reasons why M&A happens. You know, whether that's for synergies, the great cry, whether that's around assets, around people or geography, the complementary nature of an acquisition, whether that's looking at the developed or undeveloped holdings of companies, to build new core areas, less of that given the situation of the larger independents and the majors at the moment, scale economics, both scale and scope, diversification, the great cry of the past, marry capital with opportunity. There are relatively few of these transactions happening. The capital is there. Accessing it requires hard work. Access to a new skill set. Increasingly, I think this will be a driver. And finally, introducing new technology. How long can hurricanes stay out there if they continue to have the success that they have had? You know, before I open up, there's no such thing as a perfect oil and gas company. Success is more about than just establishing your portfolio and growing your assets. You now, in the new world, have to make money. And I think in the past, in high oil price environments, people, and I certainly as well, forgot that because you were focused on just getting bigger and better. I'd like to turn it over now to the floor and see if we've got some questions. If not, we have a plan B for the rest of the time should we need it. Any questions? No? Okay. Chris, have you got a handle in your...
Panel, is it true that the level of M&A activity at this end of the cycle, i.e. we've just been through a fairly major oil price correction, there really hasn't been the level of M&A activity that one might expect? Is that a function of the quality of the assets, or is it a function of some of the issues that John mentioned as to what justifies the transaction?
Yeah, I would say yes, Richard. You know, when I started in the business, I was told you explore and acquire when the oil prices are low, and you divest and develop when the oil prices are high. For a number of reasons, some of the players that would conduct that business are no longer there. I.e., the majors are in the business of protecting their future dividend stream and are rationalising their portfolios in a low price environment and are not investing in some case. You have some of the larger independents who maybe have some limitations because of their debt burden. So the food chain, which will allude to that M&A volume, I think is broken in parts. Chris, would you like, or Andy, would you like to add?
Yeah, I'll just add something on something we've been seeing as well, and it's something that has always been apparent in any marketplace as well, is understanding the relationship between the buyer and the seller, and there's been quite a big disparity and gap, and that's one of the reasons it's really held off the reasons for M&A taking place, and understanding that valuation of the seller and still holding on to. There's been quite a delay, and if I could just bring up our slides as well, I'll just bring some empirical data to show this as well. There's been quite a delay in companies and shareholders being willing to sell under that new valuation and accepting that new normal. There's been, psychologically, I think we've all been adapting to it on a pricing and net back basis, but in terms of actually then shaking hands on a deal and allowing and accepting that new price on an NPV or NAV basis under that new price valuation, it's taken some time to actually get to that point. So if I show you this slide here, this is corporate acquisitions and the share price. So we're in a corporate space here, just be aware of that. But what you're seeing here is, and this is something we've always tracked, if you see the WTI price here, it tracks almost identically the share price premium paid in a corporate deal. So 0 is the market valuation, so the share price as per that point in time. But as you can see, as the WTI price falls, it takes a little longer for that correlation in terms of the companies to actually start valuing and trending towards the share price as 0. So understanding that delay in actually being able to accept that new price, you can see here, because it's starting in 2017, for deals to happen, and those deals are happening, coming down to an almost 10% premium, whereas in 2015 and 16, it was up around 50, 60%. So the only deals that were going through were those companies who were still willing to pay and they were finding value within those assets or those corporate deals. But there weren't as many deals on that basis because the seller was still holding on to the position that they had previously valued their assets as at. So I think something like this does point towards a potential uptick in deal M&A as those buyers and sellers come together. $60 oil will certainly help with that. Even though how long that's around, I don't think any of us are starting to jump up and down just yet. But it's a nice relief, and starting to see the value of the market and the buyer and seller come together is very interesting. And just one additional point to that: understanding who you're selling to and how you sell. You've got to be very reactive in this market, and to get things through. The buyer has had their sort of position of power in the M&A space recently. So there's been some creativity, but not much. I'd say this is one area where there has been some improvement in how companies have understood how they can get a deal through. And it's basing what we're looking at here is the number of deals that have a basis upon a future commodity price. So there might be the cash position paid up front, and then there'll be a cash bonus system based on positive. It's been around $45. If that stays in place for 2-3 years, there's been additional cash payments. So you can see the jump in the number of per BOE deals that are based on that. You know, we actually tried to corroborate, is this data correct? It is. You know, people have been very quick to jump on to say, okay, well, this is a driver, this lubricates the wheels in getting these deals done. So understanding, okay, well, if we can push this over, you know, if the valuation isn't quite there, but you can base that on, you can de-risk the value, the investment, that can make deals happen. So I think we're starting to get to a position where the buyers and sellers are starting to understand what each other need. And starting to organise their deals in that base on those success criteria. So I think we're actually getting into a better place for, you know, and this is a lot of these deals are actually these dependent deals are actually at a smaller scale. So understanding and looking at how that disparity between the buyer and seller is coming together is quite an interesting space at the moment. I'd say we're not that quick in the E&P industry in getting to that place, but it's starting to get there, and I think for the first time, there's been a lot of talk of M&A starting to come together and really pick up. But I think there's a few signs looking within the market of that actually beginning to happen. So understanding that buyer-seller is, I think, really quite key, and what you can do to position your deal to get that through.
Andy.
Yeah, thanks. I think you're right, because we are seeing the buyers and seller expectations coming together. I think that what we've also seen is the food chain point that you made, John. There has been something of an absence of exits. There's been an absence of, therefore, money hasn't been possible to recycle money, and I think that's really made it difficult for companies to invest in M&A, because they haven't had the exits being provided by major oil companies, and no one's come in there really to replace them in any significant way up to now. I think the other point I would like to make at the small end of the scale is that people have been expecting consolidation in this industry for 5 years, maybe more, forever, kind of thing. But and what it doesn't happen as fast as we would all expect. And you can always point to, it's the management teams, but actually I think it's the transaction costs. We've looked as a cash shell at situations which might have involved other public companies. And the time and the cost of those kinds of transactions is significant, in comparison to the value of the deal in total. And I think that's one of the reasons why you don't see more M&A at the small end of the scale.
Sachin.
Yeah. All right. I think it's been answered largely for producing assets, some of the ways you can get around that. And obviously, North America is a much more vibrant market than international E&P. So maybe if we look at the international E&P space, and then I'll try and maybe provide the slant on pre-cash flow assets, as the producing assets, as I say, already been addressed. Now, on the pre-cash flow assets, I still think there is this issue associated with the fact that the public equity market's focus, even when it comes to large oil and gas companies, is the certainty of returns, even if they're low. I don't mind as long as I roughly know what my return's going to be. Even if it's 8%, 10%, that's fine. It's almost as though it would take that in preference to the likelihood of a very high return if I have a slightly wider outcome in my potential ranges. But that opens up a huge opportunity to actually be able to buy into the uncertainty at extremely low valuations. So that's the first point. Okay, you can buy in, but then what? Now, we've just heard about the majors having difficulty coming in and so on and so forth. And here I think in the deal, in the nature of the transaction to progress this asset with potentially high returns, you have got to be more creative about the deal. So now, you're not going to get your back costs. You're not going to get a big carry in a normal farm-out transaction. But it is remarkable how flexible companies like service companies will be in providing deferred consideration, payment on royalties, and other such forms of transactions so that they can maintain their own activity to get a license moving. The problem is this is quite unusual for the oil and gas world, and to the earlier comment about E&P companies not necessarily focusing that way, you find that this kind of ends up being a wrinkle to the way in which you can move these assets versus how you might otherwise move them forward. And you also have to be careful about trying to buy an asset out fully from at the bottom of the cycle from a company that sat on it for a long period of time, because they're going to be, they're not going to be willing to sell it. So I think there is a wonderful opportunity for the right form of constructive investment to come into the asset, buy it very cheaply, facilitate the types of deals to move it forward because the appetite is there, and then convert that range of highly uncertain but very positive returns into very positive returns, and then it will become fulfilling. So, I think there is a way of doing this. I hope Rearbold Resources does facilitate and fulfill that role, but it's certainly something that I find incredibly exciting about the way to get these assets moving forward in an M&A world where capital should be protected for going into the ground.
Thank you, Sachin. Remember, we do need the small oil sector. Oil production at the moment is at its most mature of any time. 14% of current crude production is from fields less than 25,000 barrels a day, and 7% is less than 10,000 barrels a day. We've seen a lot about supply earlier in the day. Those numbers are needed. So eventually there will need to be the deal activity to unlock the continued production from the smaller end of the barrel. Can I throw it out again and see if there's any more questions before we go to Plan C? Yes, Zach.
Just a quick question. I'd like to get the panel's input.
To what extent do you think that M&A sources from perhaps return agnostic sovereign wealth sources has driven M&A further down the food chain? And are we now seeing a reversion to mean rather than a different market?
Anybody want to go first? No, I'll go. Andy, Zach, a lot of the purchases by sovereign funds or national oil companies had such a political policy attached to them that perhaps a number of the managers, when the numbers didn't quite pan out the way they did, paid the consequences. I think the next generation who replaced them have been gun shy. I think also too a lot of those potential buyers have now got a slightly skewed view of investment banks and consultants as to how they receive the endless pitch books about the world's greatest widget. There is one point also I think on the banks here. We have seen de-manning in a number of the investment banks here. I would suggest also we've had a reduction in quality of some of the individuals or the creativity of some of the individuals in that space, because, let's be face it, they're mercenaries. They will go where the greatest activity in that sector is, and therefore the greatest bonus potential. And we in the energy industry are in the slow lane at the moment. Anybody else?
Yeah, I was just going to say, I mean, at the small end of the scale, we don't bump into sovereign wealth funds very often at all, and so I don't think it hasn't been a significant impact on the sort of things that we've been looking at, Zach, I'm afraid.
Yeah, the term sovereign wealth covers so many things, or national oil companies. I'm just thinking of like, how would you consider Ithaca and Delek, for instance? I mean, so it's a little bit difficult maybe sometimes to define the terms, but I will agree with John on the one front, which is most certainly I should find out where all the bankers have gone, which sector, and then short it. Is that the conclusion?
That's a good idea.
Right, got it.
That's
So
going to generate the money.
So that's the first thing we've learned. But kind of trying to figure out the trend, it is a frustration, but if that is indeed the case, if you're thinking about the cycles of these things, it's probably the case that the sovereign wealth funds coming back and becoming very active again will tell you where we are in the oil and gas cycle. it's also true to say I think a lot of the policy-driven incentives and the phraseology that rings in my mind loud and clear is security of supply. You know, always making sure we've got secure supply above anything else, irrespective of the returns. Now, interestingly, the security of supply issue still remains. I mean, it hasn't actually gone away that much. So inevitably, they will have to come back, but I'm hopeful that they will do it in a more disciplined approach than the way they did it previously. How that's altered the market, I'm not sure, and the small end, as Andy was saying, it's that visible to us. So in many ways, I think we're more affected by the change of the larger integrated and larger independents, who actually suffer a pretty similar dynamic to probably what the national oil companies suffered, which was the poor decision-making in the deployment of capital, because the deal-making doesn't just apply to sovereign wealth funds, it also applies to all of the super majors and the decisions they made at the time of M&A. I think the returns that they had were hardly something to, shout home about.
Yeah, just building on that a little bit. I mean, I think the time frames associated with sovereign wealth funds and the deal making are quite extended, and I'm sure that's not going to be made easier by the fact that they've not always been successful. So when we talk about at the small end of the scale about wanting to buy smartly, that means I think being ready to act quite quickly, and so I think for that reason we're not likely to see sovereign wealth funds playing at the small end of the market, and I think time frame and being agile in trying to find and close M&A deals is an important part of it, and something which perhaps hasn't come up as much as it could during the day is, when you're at the small end of the scale, you're as much as you're buying a management team as you are the asset, and sometimes in a sort of sovereign wealth fund, it's less easy for them to be thinking about the team. It's more about the asset, if you like. So I think that small end of the scale, the people are a huge determinant of the success of the venture that you're going to get into.
I mean, we work with a couple of NOCs in a couple of the areas, so Mexico, Brazil, and India. Some of the areas that are opening up, and there hasn't really been a huge amount of M&A to speak of in the sovereign wealth fund or NOC area, but working with them, there's definitely a psychological change in terms of how they're planning. I mean, those are countries as well where they're opening up opportunities as well. But there's very much a willingness to open the doors and open their opportunities to not just smaller companies, but I mean, in India you've got the small licensing rounds packages, which hasn't been as successful as they thought it would be. They did think that they would be able to recreate, and we did work with the Indian government on this, on recreating small opportunities in a lot of frontier producing assets. It was on paper they were very confident that companies could come in and find a producing asset with cash flow and develop that forward, but there really wasn't much uptake there. I think there's issues with the fiscal regime, and India can be a challenging place to work. But overall, I think those three areas, the licensing rounds you've seen in Brazil and Mexico, are really starting to pick up. There is more, and I know they're not technically sovereign wealth funds, but there is opportunity there, and I think those will impact and filter down to the smaller E&P companies with those opportunities and some of the smaller packages that may come online because of that. But there hasn't been a huge impact in what they've been doing, the sovereign wealth funds. It's more of a change internally of understanding how do they finance. Before they were the darlings of the governments, they were financing the social, political, economic positions. That's more of a focus of how do we maintain those funding for the regional, for the state positions. That's been more of their focus from working internally with some of those companies.
Any other questions? No. Okay. I'll make a few points and see if any of the rest of the panel agree with me. I see a growth in companies trying to acquire in local markets, closer perhaps to cash and to smaller bite sizes, simply because they can control more of their destiny, a la a la Vogue this morning. You know, will we see another Nigeria with the marginal fields where we saw the deployment of up-to-date technology? We saw some passion from the new owners. We saw some money really being spent on assets which perhaps a lot of the majors had not spent for a number of years. You know, the technology of drilling wells in stacked sands moved from the early 70s to now, and therefore the deeper horizons are really tangible. And we've also seen, you know, the Nigerian banks embrace oil and gas in a major way. We've now got perhaps a digestion problem as a result of that, but you know, we have to find another type Nigeria market which is open to a relationship between smaller host nations, because that is a major flavour around the world, and the small adventurous E&P companies who are prepared to work there, because in a lot of cases those assets are sub-material to the large independents and the majors. And at the end of the day, if assets are sub-material, they are not going to get on the focus of the larger companies, because they need results at the moment, and in a lot of cases they need to adjust to a scarce capital, because they have to protect the cash flows for their dividends, because it's unsustainable to continue to pay your dividends out of debt. Anybody got?
Yeah, I think that there's a lot to be said for what you say there.
John, I think that from what I see, there's a trend towards companies. It's a maturing of the business model, effectively, and a trend towards companies learning from the experience that we've had in the ups and downs over the last few years to become, as far as they can be, self-sufficient. So companies are looking for production because that's what the market values, but also because it enables them then to reinvest part of that in exploration and to create a business model that can survive and can prosper whatever the investment climate is from time to time. And I think, you know, maybe in North America that's been before, whereas in London we've perhaps learned that over the last few years about this sort of up and down in the cycle. We've funded a lot of exploration that hasn't worked out, if you like, in London, and now people are looking really, I think, to create companies that are able to sustain themselves through income going forward.
So, John, I think there's a very subtle but incredibly important point about what you were saying. I'd like to just provide one example, if I may, to hopefully make the point. There was a transaction that took place, I think it was 2 years ago, the formation of Aker BP in the Norwegian sector. And essentially what happened there was BP had a series of producing fields, Skarv, Valhall and Udin. And what was going on there was the ability to maintain their expected production plateau rates in the lower oil price deck than was expected when they originally put the projections out was never going to work. It did not make economic sense to keep that asset at plateau, right? So it was going to go into decline, and then to your point, John, it becomes immaterial. So what do? We could theoretically just sell the asset. Well, interestingly, we had a pre-cash flow asset in there, the Johan Sverdrup's field, which I'm sure people know about, where Det Norsk could not get third-party funding at anything other than incredibly high assumed return requirements. And the beauty of the transaction in the formation of Aker BP was to take the capex that was going to go into BP's portfolio and apply it to the Det Norsk portfolio and arbitrage a huge differential in the return requirements for the assets. And you've seen, hopefully, what the share price has done, and that happened, please bear in mind, in a falling oil price environment. Right? The troubling of it.
No, absolutely. Right. I see, other situations where you're going to see, you've heard people today, John started the ball. There were assets that Glencore no longer want to keep. They want to remove out of the license commitment. They want to get rid of that work commitment. Other people coming in have therefore acquired at a very low entry price. And if they have any of the synergies, any of the compatibilities I mentioned earlier, then that becomes potentially an accretive transaction to them. But the corporates have got to work harder at this game. The ability of banks to deliver you a cookie-cut transaction that maybe happened before and to guide you through step A to Z, and by the way, here's the check, are gone, in my view. It will take considerable time for it to come back. It is going to be the passion of the management teams and their attention to detail and their knowledge of that business, that country, or that technology that is going to win out here. This is about high-quality delivery of resources against a focused target in my book.
Yeah, but I just wanted to extend it from there, and I take that as a proven example. I think outside North America and Nigeria, as you'd indicated, and even if you go around the presentation booths today, there are so many sub-basins where you could apply precisely the same concept. Now, we don't have, and we're blaming the bankers for an awful lot here, John, by the way, so maybe you know, this is incumbent on all thank you, on all industry participants.
Yes.
And I have to say, the reason I'm saying this so passionately, it's really the bedrock of what Reobold is attempting to deliver in the areas of focus. And you don't have to go that far. We are talking about continental Europe. We are talking about areas in the UK. We're talking about geographies and geologies which are, in inverted commas, you know, perceived to be politically safe. It's just a way of finding how to do it a little bit differently, given we know capital is constrained and can't be spent on doing the deal. The capital has got to be spent to going in the ground. So how do we then consummate a marriage that creates value for all? Aker BP is not the only one. And you know, obviously we believe we're going to participate in that, but I would just, a passionate plea is for all industry participants to feel that way. Not everybody has the single best opportunity ever. That just can't be true. Not every company, an E&P company, has the best one of all time. Right? There is a way of working together with your neighbor. You mean we're not going to be a dot-com bubble again? There's a way of doing this.
Richard.
And, you know,
What screening price do you think corporates are using to evaluate? Clearly
depends whether I'm a buyer or a seller, doesn't it, as it were?
We saw it years ago when people used to run $18 oil scenarios pre-2000. We're now in a situation where the oil price has spiked up above $50 a barrel. In the last 3 months, it's edged towards 60.
Yeah.
And you've got the hedge funds buying in and talking up the oil price because they would. But at the end of the day, what price does buyer and seller make?
I believe we are still in the 50s market and the low 50s in there, because one needs to see the sustainability of a 60. But I would suggest there's another driver in here that is perhaps a larger elephant in the room. We are, as an industry, fixated on PV10. I believe PV10 existed when there was a free and easy access to cheap bank debt, or relatively cheap bank debt. I fear that is not the current situation, and therefore is PV10 the right matrix? Correct. Well, we hope they are. Otherwise, again, we have a digestion problem in the system, because it will just gum up.
Yeah, I couldn't agree more on the PV10 point as well. I do actually think there is a lot of capital out there, and a lot of the companies that we speak to have more opportunity, more equity than they know where to invest it with, and oil and gas is quite far down on their list. You know, some of them have been burnt. Some of them, you know, a lot of the what Evaluate Energy does, we're data and analytics empowering the decision makers. So a lot of the time we'll be feeding into the CFA team accountants who are helping the CFOs make the decisions. And a lot of those analysts are not what they used to be. They don't have the independent oil and gas houses anymore within those companies. They have generalists. And when you're dealing with a generalist, it's again understanding who you're selling to. It's not an E&P company anymore, it's a generalist. And when they have those opportunities in front of them, they may not always go into PV10. We've had companies who are making decisions purely on current production, and they'll make their own estimate. We had an example from one of the major banks a couple of weeks ago when they were insistent that we were missing the farm-in deals when we'd given them all of the farm-out deals. So when you're dealing with a generalist investment portfolio like that, you really have to get to them on core financial principles, and that's becoming a real challenge with the historic data that you have in the oil and gas. There's been a lot of talk of cash flow going forward, and I think that will be the case. But a lot of the decisions that we're empowering, and that's most of the banks and investment houses within the UK and North America, that data that's feeding into there isn't very positive, and they're benchmarking that against the historical position. So those new analysts that come through, high turnover, they don't always have that long memory. They're not oil and gas specialists. Pushing those people to a decision where oil and gas is a good investment is really difficult. There's a lot of companies we're feeding information to, and they take the data and the analytics, they keep looking at it, and they keep saying no. We'll look elsewhere. It's not appealing to us.
Andy.
Yeah, I think it's part of the nature of the beast that, we've just given you an example of us at Spinnaker Opportunities, and we've looked at maybe 50 opportunities at screening, and we're looking to do one deal. There's 49 reasons why, I can think of 49 reasons why something like which has been rejected, if you like. So it's a little bit the nature of the beast that we end up discussing why deals don't happen. And I think that I'd like to give a little bit of a bit more of an upbeat feel to it. I think actually, we're very confident at Spinnaker that we will do a deal, and I think Sachin is probably confident that Rearbold will as well. There are lots of reasons. There are lots of deals which are being done, but they're inevitably the tip of the iceberg. And I think that where I see positivity, if you like, is in the general economic backdrop. I think is supportive at the moment. I think. So we're seeing growth. I think that will encourage people to want to invest more and to look again at the oil industry. It encourages the pricing, if you like, and give people confidence, even if it's only a confidence of $50. And I think the sort of themes that we'll see emerging are the ones that we've heard today. There are opportunities to invest in gas. There are opportunities to invest in Europe and in gas. There's opportunities to invest in production, and there are many areas which I think. There you could build a really good story around at the current sort of prices. So I think it's good to explore why we're not doing deals, and it's necessary to do that, and how things could be better and so on. But it's not horrible. I think that there will be deals done over the next few months, or continue, perhaps accelerate a little bit.
Yeah. Thanks, Andy. You made me feel better. I was getting slightly worried there for a second. And I do agree with everything Andy said. Otherwise, obviously we both wouldn't have attempted to do what we are doing. But to go back specifically to the question on let's call it the PV10 question. Again, speaking, having been the analyst, I remember when oil was at 100 and had just started to fall off a cliff, and we were modeling everything, or I was being asked to model everything from inverted commas, the generalist, that if oil falls from 100 to 50, let's say, what happens? And it turned out, I don't think a single drop of oil pretty much anywhere in the world, I'm exaggerating clearly, was ever going to be produced. And the bit we kind of forget here is that the speed with which, and in oil and gas, rather than mining, for instance, the capex per BOE is such an important driver in determining the return economics. Now, when you then take that back in the run-up for the oil price from 50 to 100, you saw precisely the same thing in reverse. But here is one thing that did not change very much. The relative curve in terms of the capex and opex intensity per BOE remained largely unchanged. In other words, a project that was a good project, the last time round in the cycle at 50, is actually a good project even at 100, and in truth turned out to earn a better return in today's price deck than it did in the 100 price deck because of where the overheating had taken place in the supply chain. Now, this is assuming you were going to make the investment, not that you've already made the investment. And the reason why this is important is when you buy the asset today and think about your capital decision, you have got to be really careful about thinking what your cost environment is when you're making the investment, because that's almost turned out to be more important than the oil price over this 8 to 10 year period. And it's something that just gets forgotten, and I say that kind of, again, really emphatically, because that's been my experience, both on making money at the project level and at the equity level, in terms of understanding where the project sits relative to overall projects in E&P space. Of course of course. It's the full cycle cost. I'm saying, don't imagine you spent it at $100 per barrel and then say, what are my returns now? Because clearly you've spent the money. But
thanks, Sachin.
Yeah.
You know, picking up a point that Sachin says there, I'm very much in the mode of the actual assets are almost secondary. It's the decisions that influence performance are around management and how they balance the 99 questions about doing a deal. And maybe I have knocked some of the banks in the process here, because passion, creativity, hard work needs to come from the industry to drive the deal. The effectively a package deal being delivered to you, I think, is not going to happen in the near term. You're going to have to work harder for it, but there are deals that can be done. We have run out of time, and I have Adam waiting here to conclude, and I hope that you go to drinks with some controversial comments ringing in your ears. Thank you very much.
Round of applause for our panel, please.